Next, I am going to explain about functions of insurance. The various functions of insurance are as follows: providing certainty. Insurance provides certainty of payment for the risk of loss. There are uncertainties of happening of time and amount of loss. Insurance removes these uncertainties and the assured receives payment of loss. The insurer charges premium for providing the certainty. Protection. The second main function of insurance is to provide protection from probable chances of loss. Insurance cannot stop the happening of risk or event but can compensate for losses arising out of it. Risk sharing. On the happening of a risk event, the loss is shared by all the persons exposed to it. The share is obtained from every insured member by way of premiums. Assist in capital formation. The accumulated funds of the insurer received by way of premium payment made by the insured are invested in various income generating schemes. Next, I am going to explain about the principles of insurance. The principles of insurance are utmost good faith, insurable interest, indemnity, proximate cause, subrogation, contribution, mitigation. And now let us see what is that utmost good faith. A contract of insurance is a contract of uberime fidei, a contract found on utmost good faith. Both the insurance and the insured should display good faith toward each other in regard to the contract. It is the duty of the insured to voluntarily make full, accurate disclosure of all facts material to the risk being proposed, and the insurer to make clear all the terms and conditions in the insurance contract. Thus, it is binding on the proposer to disclose all material facts about the subject matter of the proposed insurance. Any fact which is likely to affect the mind of the prudent insurer in deciding to accept the proposal of insurance or in fixing the rate of premium is material for this purpose. Failure to make disclosure of material facts by the insured makes the contract of insurance voidable at the discretion of the insurer. Insurable interest. The insured must have an insurable interest in the subject matter of insurance. One fundamental fact of this principle is that it is not the house, ship, machinery, potential liability of life that is insured, but it is the pecuniary interest of the insured in them which is insured. Insurable interest means some pecuniary interest in the subject matter of the insurance contract. The insured must have an interest in the preservation of the thing or life insured, so that he or she will suffer financially on the happening of the event against which he or she is insured. In case of the insurance of property, insurable interest of the insured in the subject matter of the insurance must exist at the time of happening of the event. In order to name insurable interest, however, it is not necessary that one should be the owner of the property. For example, a trustee holding property on behalf of others has an insurable interest in the property. Indemnity. All insurance contracts of fire or marine insurance are contracts of indemnity. According to it, the insurer undertakes to put the insured in the event of loss in the same position that he occupied immediately before the happening of the event insured against. In other words, the insurer undertakes to compensate the insured for the loss caused to him, her due to damage or destruction of property insured. The compensation payable and the loss suffered are to be measured in terms of money. The principle of indemnity is not applicable to life insurance. Proximate cause. According to this principle, an insurance policy is designed to provide compensation only for such losses as are caused by the perils which are stated in the policy. When the loss is result of two or more causes, the proximate cause means the direct. the most dominant and most effective cause of which the loss is the natural consequences. In case of loss arising out of any mishap, the most approximate cause of the mishap should be taken into consideration. Next is subrogation.